Congratulations. Okay, good morning. We're here for our final week of class. Brian's really excited because he's graduating. Not only is it his last week of the semester, but of his college career. Chapter 13 this week. Chapter 13, before we get there, we have some administrative details. What's due this week? Probably the shortest. Yeah, there we go. Saturday, attendance quiz 26 is due, and Chapter 13 homework in my accounting lab. And by the way, for the Chapter 13 homework, we're going to do a homework problem today in class, and the rest of the homework problems were embedded in the Chapter 13 videos. So after today, you would have all the homework problems, so you could do the homework after today. Now we're on to the final exam information yet again. Okay, final exam. Final exam is due by 6 p.m. on Thursday. Notice it is 6 p.m. You need to finish up before 6 p.m. on Thursday. It covers chapters 8 through 13. Similar in format and length as other exams. You can have the one note sheet. You do not need to bring present value tables. They'll be provided within my accounting lab if you need them. Also, if you take it Sunday, and I'm just by doing straw poll, a lot of people are planning on taking it Sunday, and we do have the capacity on Sunday, I believe. We have 72 computers at 8 a.m. I will be there. There will be at least one other proctor there with me at 8 a.m. so we can get you started. And there are a couple other classes that may be taking exams in the afternoon, but I would urge you to get in there as early as you can. If you complete the final exam by 6 p.m. on Sunday, you'll receive an additional 12 points. This is the only way you can get the 12 points is taking it Sunday. If you're on ProctorU, you have to submit it by 6 p.m. 6:01 isn't going to get you the bonus. And if you're going to take it in the lab, you have to start it by 4 p.m. on Sunday. And again, Sunday, I'm going to see a lot of you there. I'm there as a proctor. I can't answer questions about the exam. Same goes for Brian because Brian will be there too. I think I'm taking the earlier shift, and so we will both be around. So happy to smile at you, but we're not going to be able to carry on conversations about final grades or anything like that because we don't want to distract other students as well. So just know that when you see us there. Okay, final exam review sheet. I posted it on Blackboard. Okay, the final exam review sheet. It is on Blackboard under exam info. You can also get to it directly at http://tiny.cc/final exam. Okay, and that's like the previous review sheets, kind of giving you an outline of the material. And Brian typed it in the window there as well if you'd like to grab it. And again, you can get this on Blackboard under exam info. I did post it there or here. And then one more announcement before we do Chapter 13. During finals week, my office hours are different than during a regular week. Finals week, our finals over Thursday by 6 p.m. I'm going to have office hours Monday and Tuesday from 8 a.m. to 10:30 a.m. both days. So outside of that time, we'll correspond via email. But I will be in my office on Monday and Tuesday morning. So if you need me, come see then. I suspect a large majority of students will be coming to take the exam Sunday. Also, about final grades, I don't have a slide for it, but final grades, just so you know, our exam is over Thursday at 6 p.m. In a perfect world, I would have grades done Saturday. Okay, and I'm hoping it's a perfect world because Sunday I leave for Europe with my study abroad class. So your grades will be in Flashline before Sunday noon when I depart. Okay? So when you take your final exam, let's say you take it Sunday, if you email me and say, is there going to be a curve, my answer is going to be no. Typically, don't curve the final. We don't need to. And I'm not going to know until all the exams are done anyway. Please don't, here's another don't, and I'm sorry. But if you email me Sunday and say, I'm only 1 point away from the next higher grade, will you make my grade higher? No, I am not adjusting any one student's grade. I will not do that. That is not fair to everyone else. What happens is once everyone's completed the exam, so I can't look at an individual person's grade scenario until everyone's done with their exams. Then what I do is I look at the overall grades in the class and I use that grade scale that's on the syllabus. And there will be people close to the next higher grade. There will be people a point away or a 0.1 away. And unfortunately, that's the way it is. Because if I say, okay, you're only this far away, then there's another person that's only 0.1 away. The way it always works out, there's people all across the spectrum, and wherever I draw that line, there's going to be people close on the other side. So my advice to you is do the best you can. Know that I will let you know when I have entered the grades in Flashline. I would expect that to take place Saturday, just knowing that I'm heading to the airport on Sunday. So I would hope to get the grades in Saturday. I will put an announcement and email an announcement out. It would be good if you would look at your grade, verify it then, because if you email me Monday after finals week, like, you know, after, I'm not going to be able to do anything until I get home 2 weeks later. So do take a look at your grade. But the point is that if you email me Sunday after you take the exam and say I'm 0.1 away, I'm not making an adjustment for any one student. If I make an adjustment, it's across the board and everyone will get the benefit of that. So it would do you no good to say, can you bump me up? Because if I'm going to bump anyone up, everyone will get bumped up. I mean, it's just, I will apply that evenly across the board to be fair to everyone. So just know that when you finish the exam, that grade in My Accounting Lab, when you click on results and you see your overall grade, if you compare that to the grade scale on the syllabus, that is more than likely your grade in the class. That grade scale on the syllabus, use that grade, the overall grade in My Accounting Lab. And when I say when you finish the exam, if you finish Sunday, you're going to have to wait until Sunday evening to see the effect of the 12 points added on, because that gets added on Sunday evening. Okay. Okay, questions about anything like that as we come on the last. Okay, so then we'll start our last chapter. And this is a really nice chapter to end on. It's financial statement analysis. And it's not hard. This is the kind of chapter where you have formulas. Very, very structured chapter. There are 6 learning objectives, but that's misleading. They're very short, and some of them are kind of, the first 3 learning objectives are related to each other. Horizontal analysis is comparing year to year to year. Vertical analysis is comparing different line items on the income statement or on the balance sheet. Common size statements is putting your statements in percentage form so you can compare to different companies. So those 3, learning objectives 1, 2, and 3 are all interrelated. And then 4, we did statement of cash flows, so this isn't vastly different. And then 5 and 6 just have ratios with formulas. So, and you watch the videos on these. So what we're going to do now is we're going to do a few questions, and then are those 12 percentage points. It's 12 points added onto your score. There's 100 points on the exam, and so if you finish up with 88, you're going to get 12 points added onto that to make it 100. So it's just a flat 12 points. So not percentage. We don't take 12% of your score, but it's just 12 points. Okay, so see. First question. So we're going to have we're probably going to have 5 or 6 questions dealing with these vertical analysis, horizontal analysis, and common size. So you would have watched the video. So let's start with this one and try to answer it. Vertical analysis highlights changes in financial statement balances from period to period. True or false? What do you think?
True.
True? True. Do you want to change your answer? Yes, you do, don't you? Okay, vertical analysis. Okay, so this is, and a lot of these are warm-up questions for today. So, vertical analysis. Vertical analysis is comparing everything in a column of numbers. And you have a column of numbers, you have a balance sheet, you know how numbers are in columns. Vertical analysis is comparing everything in a balance sheet as a percentage total assets. In an income statement, it's as up a percentage of net sales. So vertical analysis is that whole column. Think of a column as being vertical, and it's comparing things within that same year. So it's this question, actually, horizontal analysis highlights changes in balances from period to period. Horizontal is a time measure. Vertical is items within the same statement. Okay, let's try this next one then. The next one, which is horizontal analysis, starts with horizontal analysis, compares financial statement items in the current period with other items in the current period. True or false? Do you have the answers online, Brian? 6 falses and 2 trues? Yes. So, yeah, generally it's false. So this is false because this is exactly what vertical analysis is. Horizontal analysis was items within the same period. Horizontal analysis is period to period. So this one's false. Actually, if it read vertical analysis compares financial statement items in the current period with other items, that would be true. Now, continuing on about the comparing from period to period or within the same. So horizontal analysis is comparing period to period. Okay, so now when we're talking about horizontal analysis, the percentage change in financial statement balances is computed by dividing the dollar amount of the most recent period by the base period dollar amount. True or false? Is that mine? Wow, that was rather random. Okay, so in this, we're talking about horizontal analysis. So this is horizontal analysis. when you're computing that percentage change from period to period, this one is false. And the reason it's false, and this is good to remember because this is easy to get confused on. So this is a little tidbit I would put on my review sheet, that you divide the change between the periods by the base period dollar amount, not the original amount. So the question was asking, do you divide 1 year by the prior year? No, you divide the change between the years by that base period amount. Now this is horizontal analysis. Horizontal analysis is comparing year to year. We can also compare month to month or quarter to quarter. For right now I'm just going to talk about year to year. But when we're doing horizontal analysis, we compare 1 year to another year. And we do this for 3 statements. We do it for the balance sheet, we do it for the income statement, and we do it for the statement of retained earnings. So it's important to note that you do this on more than one statement. You do it on the balance sheet, the income statement, and the statement of retained earnings. We don't, I guess we could on the statement of cash flows, but the big ones are the income statement, the balance sheet, and the statement of retained earnings. Okay, now switching back over to vertical analysis now. Thinking about vertical analysis says let's take everything as a percentage of net income or everything as a percentage of net sales. So I'm going to answer this one right now for my, okay. When comparing companies of different sizes, this is important to note, vertical analysis is a useful tool. Vertical analysis allows us to compare a company that's very big to a company that's very small because it puts it in percentage terms. Okay, 2 important facts for you to put on your sheet, and I don't have them on a slide. And Brian might type these in the little box, the text box. No, you're not going to? Okay. The base on a balance sheet is total assets. So when we're doing vertical analysis on a balance sheet, we divide everything by total assets. So the base on a balance sheet for vertical analysis is total assets. Okay, so that's one thing. So whenever you see a balance sheet, every single item on a balance sheet, if you're doing vertical analysis, is divided by total assets. Now the other fact you need to know and need to write down, the base on an income statement is total sales. Sales revenue, total sales. We do sales revenue. Total sales, sales revenue, yeah. Yeah, good, both of them, yeah. Okay, the total sales and sales revenue are the same thing. We could express it differently. So when we're doing vertical analysis, we're just looking at the balance sheet and the income statement here. We divide everything either by total assets on the balance sheet or total sales on the income statement. Okay, important to know that for questions like this next one. Okay, so when performing vertical analysis of an income statement, net income is usually used as the base. True or false? What do you have online? Okay, 9 falses, so that's good. It is false, and the reason it's false is because that's not net income, it's sales revenue is used as the base. Okay, one more question, then we're going to do the homework problem. Okay, the relationship of each individual asset as a percent of total assets is an example of vertical analysis. What do you have for answers? 4 truths. 5 truths? Okay, and it is indeed true. The relationship of each individual asset as a percent of total assets, that's vertical analysis on a balance sheet actually. Vertical analysis is comparing an item in the financial statement to a base in that same period, not a prior period. Horizontal analysis is prior period. Vertical analysis is same period. What we're going to do now is we're going to do the homework problem that's not in the videos. This is exercise 1321A. This is an excellent problem in terms of going through a lot of the different ratios. So now we're transitioning to learning objectives 5 and 6 pretty much with this exercise. You're not going to be able to write the data sheet down, but know that you can come back here to refer to it, or this is in your book, exercise 13-21A. So what it asks us to do is compute the following ratios for 2012 and 2011. So it's asking us for a series of several ratios. And then the second part of this exercise asks us to evaluate their liquidity and their debt paying ratio. That's part 2. And then as a manager, what would you try to improve next year? So this is asking us, so we've got these other 2 questions. So what we're going to do on this one is we are going to answer, we're going to work our way through. So we have these questions 2 and 3 about evaluating the company. We're going to answer question 2 as we go through part 1. So we're switching back to part 1 here. In part 1, note that it says compute the following ratios for 2 years. The current ratio, the quick ratio, etc. So we're going to be computing all those ratios. So what I'm going to do for part 1 is you're going to see the bottom part of this disappear, so I have room to put it down. And part 1A is asking for the current ratio. So what I'm going to do is I'm going to put the formula down here. So this is the formula for the current ratio. The current ratio measures our ability to pay our current bills, the ones that are due within the next year. So the current ratio is current assets divided by current liabilities. On my sheet for the exam, I would definitely have all these ratios. I would go through and write down all the ratios from the chapter, but we're going to go through and compute these so we can see them. So we have 2 years to compute 2012. What we're going to do is we are going to take our total current assets of $245,000, divide by our total current liabilities of $131,000, and we get a current ratio of 1.87. And remember, for all of these, we have to do it for 2012 and 2011. We're going to do exactly the same thing for 2011. So for 2011, we'll move over to the 2011 column, and we're going to take the 268 divided by 90,000 to get 2.98. So we're taking our current assets divided by current liabilities. The current ratio, pretty straightforward. Now, question 2 on this exercise, 2 or 3, says to evaluate the ratios. And we're going to do that now as we go through it. So as we look at this, the current ratio measures our ability to pay our current debts. And what it's doing is it's saying how many, relatively speaking, how much more current assets or resources do we have than our currently due debts, and that's what it's measuring. So and the rule of thumb is this should be greater than 1 and it's going to vary widely from company to company and from industry to industry. But rule of thumb, you want our current ratio to be greater than 1. We want to have enough resources to be able to pay our current bills. So in this case, in 2012, we have a current ratio of 1.87, which isn't bad all by itself. But just like if you go to get a measure of your health, they don't just simply weigh you and say, oh, we can evaluate your health based on this one number. You can't. You have to look at other things. So that's why we do another year and we do other ratios. So in 2011, we look at the current ratio, and we see they had a current ratio of 2.98, which was even better. The rule of thumb on a current ratio is all other things being equal, the higher the better. So you want the highest current ratio. I mean, you balance this against a lot of other things. But the fact that we went from 2.98 down to 1.87 is a little bit troubling, because this is not moving in the direction we would want to see it. Of course, it is only one measure, so we just take note of this, that their liquidity, or their ability to pay their current debts, their liquidity, is decreasing according to the current ratio. So there's that. So that's the first ratio we do. And we're going to do that now with each of the other ratios that asked for. So the next ratio is the quick ratio, also known as the acid test ratio. And this one is just a stricter, it doesn't include as many current assets, so it's a more conservative measure of liquidity. And what this is, how we compute it, is we take the cash plus the short-term investments plus our net receivables, divide that total by our current liabilities. On this one, the quick ratio or the acid test ratio, it is meant to be a more conservative measure of how liquid you are. It does not include inventory, because the feeling is that inventory can be hard to move. If things turn bad, we could have trouble selling our inventory. So that's less liquid than other things. And then prepaid expenses, typically we can't turn those into cash, so that's why they're not included. So the quick ratio, again, we would like to see it above 1 or above, and we do this company's quick ratio. We get for 2012, if we go through and we add the cash of $53,000 from 2012, the short-term investments of $17,000, and the net receivables of $77,000. We divide that by our current liabilities of $131,000. We get 1.12, which again is above 1. So we go, okay, that's decent. But then we do 2011. In 2011, we do the same thing with the 2011 numbers. And when we do that, we have a quick ratio of 2.11. So I'll wait for a minute while you write those down, and then we'll talk about this one too. With the quick ratio, over 1's good, decent, but again, it varies industry to industry. So in 2012, all by itself, 1.12, you think they're okay. But look at 2011, it was 2.11. So what we see here is their liquidity has fallen by measuring the quick ratio as well. So that too is a little bit of cause for concern. So this deteriorated. All other things being equal, your quick ratio, the higher the better. So you need to be able to look at ratios and know if it's a positive trend or a negative trend, meaning is it favorable for the company or not. A quick ratio that's decreasing, that is not a good thing. That means you're getting less liquid. It's getting a little harder to pay the bills. But they're still fine. It's just you would want to look at it a little closer, more things. So we'll look at more than just the quick ratio. So we've done the current ratio and the quick ratio. The next one it asks for is the inventory turnover and days inventory outstanding. Okay. So inventory turnover and days inventory outstanding. And actually this is a two-part two-part one. We actually have two formulas to make this up. We have to first calculate our days inventory. We need to calculate our inventory turnover and then use that in our days inventory outstanding. So it's a two-part ratio. There's one other thing we need to be concerned with here. So we know to get inventory turnover and days inventory outstanding, we have to do two calculations. And in that top calculation for inventory turnover, notice how it says average inventory. That word average is extremely important. That means we can't just take the end of year inventory. We can't just for 2012 take the ending inventory of 90,000. If it says average inventory, we need to take the ending inventory from 2011, add it to the ending inventory for 2012, and divide by 2. So you're going to take your beginning of the year inventory, your end of the year inventory, divide by 2. So we'll see that going forward here. So what we are going to do first is we're going to do 2012 first. So I don't have enough room now to put both of them on the same page. So 2012 first. When we do cost of goods sold is $276,000 in 2012. We'll divide that by our average inventory, which is the 90,000 plus 72,000. I'm going to wait for a minute while you write this down, and then I'll talk about it a little more. Inventory turnover. So we take our cost of goods sold and we're dividing by our average inventory. So whenever you see the word average, we're going to see it in other ratios as well. You have to take this year end, last year end, add them and divide by 2. That will give you the average. You can have a problem that will only give you one. It'll say average inventory was. Or if it just gives you one inventory figure, use that. So you can have it, especially in a multiple choice format, it might give you the average, but you do know that is average. So we calculate our inventory turnover ratio is 3.41. That means we sell our inventory in 2012, we sold it in an average of 3.41 times. We replaced it 3.41 times is what happened. That inventory turnover ratio will vary widely from company to company. The reason it will vary widely is because the turnover ratio is quite different. If you're looking at a grocery store, if you go into Giant Eagle, you want them to have a really high inventory turnover ratio because you expect them to sell today's milk and bring in fresh milk tomorrow, etc. Whereas if you go to a jewelry store, it's going to be a lot slower. If you're Boeing, their inventory turnover ratio is very low. Takes a long time. So we get to 3.41. Then we go on to days inventory outstanding. And there we're taking the number of days in a year. We're using 365, divide by that inventory turnover ratio we just got, and we get 107 days. What that 107 days is that tells us on average it takes 107 days to sell our inventory. That is very specific to an industry. We don't know anything about that looking at just 2012. So what we're going to do now is we're going to switch to 2011 and calculate the same thing because a lot of times trends will tell us more. So now we go to 2011 and it's going to just suddenly appear. 2011, our cost of goods sold, just looking in that column, cost of goods sold $280,000. Average inventory for 2011, we take 2011 ending inventory and add 2010 ending inventory. What we have here then is when we calculate the days inventory outstanding, we get 86 days for 2011. So in 2011, it took us 86 days to sell inventory. In 2012, that increased to 107. So it's taking us a lot longer. That didn't just go from 86 days to 87 days. It went to 107 days. So this is cause for concern as well. This ratio is heading in the wrong direction. In 2011, we sold on average 86 days. In 2012, 107. So this ratio is not looking real good either. So that's the inventory piece of it. So we've looked at liquidity. We know that liquidity is decreasing. We just looked at inventory, and we know it's taking longer to sell our inventory. So then the next thing we look at is the next one we're asked for, is the accounts receivable turnover. Accounts receivable turnover is how fast we get our money, we are collecting from our customers. So the formula, again, it's a two-parter. We have two pieces here. Accounts receivable turnover is net sales divided by average net accounts receivable. And down at the bottom, just another note, again, to get an average, we take our beginning and add our ending and divide by 2. That word net is important. We don't have to do anything different with it in this one because it tells us in the data set that we're dealing with net receivables. It actually says that in the statement they gave us, the balance sheet. Net receivables simply means that we have our regular receivables, and we subtract our allowance for doubtful accounts. So that's all that's talking about. Anyways, net sales for 2012 is going to be net sales 494,000 divided by our average accounts receivable. Again, we need to take our 77,000 2012 receivable, add the 2011, divide by 2 to get that average. So our accounts receivable turnover is 6.29 in 2012. Now in 2011, we're going to do the same thing with the 2011 numbers, and we get the accounts receivable turnover of 7.43. Looking at the interpretation of these then, the 6.29 is how many times we collected our receivables during the year. We collected 6.29 times. 2011, we collected 7.43. The higher the number, the better. So this looks to me like our receivables are starting to slow down too, meaning our customers are probably taking longer to pay us, which is not a good thing. The longer a customer takes to pay you, the less chance that you're going to get paid ultimately. Next ratio then, working our way down, days sales and average receivables, or days sales outstanding. And what we're going to do here is we have to do a couple things. We have the days sales outstanding, which is average net receivables divided by 1 day sales. So the average net receivables, again, is 77,000 from 2012 plus the 80,000 2011, divide by 2, and divide by 1 day sales. 1 day sales, the 1,353, down in the lower right-hand corner, I show you how I get that. To get 1 day sales, you take your total sales and divide by 365 days in a year. That's all that's asking for is, on average, how much do you sell in 1 day? So you take your total sales for 2012 of 494,000, divide by 365 days, and it comes out that on average you sell $1,353 worth per day. And you use that in the calculation. So our days sales and receivables is 58 days for 2012. Now we move on to 2011. And what we see for 2011 when we do those same calculations is we get 49 days for 2011. And the average day sales, again, you take the sales for 2011 of 502,000, divide by 365. And we get the 1,375. So I'm going to wait for a minute while you catch up on writing, and then I'm going to talk about interpreting these. What we see here then, in 2011, it took us on average 49 days to collect from a customer. On average, the average customer took 49 days to pay us. In 2012, the average customer took 58 days to pay us. So this is alarming as well. This is just one more clue that things are not moving in the right direction. The other thing when you look at this, what strikes me when I see this is 49 days. On average, it takes a customer 49 days. Typically, we are not told here, but typically payment terms are 30 days. And if we have payment terms of 30 days, what this means is on average our customers are taking 49 days to pay us in 2011, and then in 2012 they took even longer. The longer a customer takes to pay, the more chances is they won't pay. So, and it also drags us down because it takes us longer to get our cash, which then takes us longer to pay our vendors, etc. It's a vicious cycle. So this ratio, when we're interpreting this one, this is moving in the wrong direction too. It's taking longer for customers to pay us, okay, or to collect from customers. And then we have, we're going to look at the next ratio. It talks about how long it takes us to pay our own bills. So the first one we're going to do, we do 2012 and then 2011. So letter F, when we're talking about accounts payable turnover and days payable outstanding. Okay, so we have two, again, this is a two-parter. So we're first going to calculate our accounts payable turnover, and we're dividing by an average, and then we'll calculate our days payable outstanding as well. We're going to start with 2012. And what we're going to do for 2012 is calculate our accounts payable turnover, which cost of goods sold is given to us as $276,000. Average accounts payable, again, because it has the word average, we take our 2012 accounts payable, add our 2011, divide by 2. Then we get the 4.6, and then we get days payable outstanding of 79 days. That's 2012 then. We had days payable outstanding of 79 days. We fast forward, and basically what you need on 2011 is that bottom line. 2011, you do the same thing, and you end up with days payable of 68 days. So we went from 68 days in 2011 to 79 days in 2012. So the interpretation there is it's taking us longer to pay our bills. And if we think about this, it took, in 2012, this is 2011, in 2012 it took us 79 days on average to pay our bills. That's horrible. If you're in a business and you routinely pay your bills really late, I mean 79 days is really late if you're talking about 30-day credit terms. Eventually your creditors are going to cut you off. They're not going to ship items to you unless you pay in advance, which is really hard from a cash flow standpoint. So this is not a good thing either. So what we've seen so far, out of all these ratios, every single one has deteriorated. We see that their liquidity is decreasing and their ability to sell their inventory is slowing down. Their ability to pay their bills is slowing down. So none of these things are good. The last thing it asks us, the last factor it asks us for is the cash conversion cycle, which is looking at, on average, how long it takes a piece of inventory to turn into cash in our pocket is essentially what it's saying. And what we're doing here is we're taking three factors we've already used: the days inventory outstanding, the days sales outstanding, minus the payable outstanding. So the days inventory, this is when our inventory, how long we have our inventory, how long it takes to sell it, and then subtract out how long we take to pay. So our cash conversion cycle, how long it takes to turn into cash in 2012 is 86 days. So we just go through what we just did, looking at each one of those numbers that we calculated previously. We had days inventory outstanding of 107. We had days sales outstanding of 58. Subtract 79 for days payable outstanding. So we have 86 days. So bottom line, our cash conversion cycle for 2012 is it takes 86 days for our inventory essentially to turn into cash for us. The formula for one-day sales, I'm jumping on that. It's just, or you can answer it too. Go ahead. Brian's going to answer it, but I'll say it fast. It's our sales divided by 365 days. Okay, then for 2011, we do the same thing, and when we calculate our cash conversion cycle for 2011, we end up with 67 days. And what's going on here then? Cash conversion cycle last year was 67 days to turn into cash. Now it's 86 days, which is much longer, which is not a good thing either. So every single ratio we've looked at here has declined, deteriorated. So this next page, you don't have to write it down. It's just a summary of every ratio that you've already written down. So in 2012, the current ratio went down. Current ratio measures our liquidity. Our liquidity decreased, which is not a good thing. Quick ratio, also another measure of liquidity, it decreased. Inventory turnover, we went from selling our inventory 4.2 times to 3.41 times in a year, so that's deteriorated. Days inventory outstanding, how long on average it took us to sell. Inventory is 86 days to 107. That went down as well. Receivables turnover decreased, which means we're not collecting receivables as fast. And when we see days sales outstanding went from 49 days to 58 days. Payables turnover, we're slowing down paying our own bills. That's not a good thing. And finally, our cash conversion cycle lengthened, which is not a good thing. All other things being equal, we want our cash sooner. So this company has deteriorated on every factor from 2011 to 2012. What would you try to improve next year? The biggest bang for their buck, if they could want to work on inventory turnover and cash collections, we need to make more sales and we need to collect from our customers faster. So it may mean picking up the phone and calling customers when they're one day late. It may mean perhaps offering a discount for early pays, but somehow increasing payment and increasing our sales. So if we increase our sales and we increase if we increase how fast we get payment from our customers, that will help in the other things. When we're paying our bills slow, that's a direct result from us having lower sales turnover and lower collection from our customers. So we concentrate on the collection side and we concentrate on the sales side, those other things are going to work themselves out. Okay, so that actually brings me to the end of what I wanted to do for today. Now, what we have left on Thursday is I have a series of questions, and we'll talk more about the final. I'll answer any questions you have. I anticipate Thursday being a short class. So that's it for today.